In an American city on a rainy Tuesday night, a gig driver checks their phone, merges across heavy traffic, and accelerates, chasing the next fare. It is a high-speed, high-stress grind that operates continuously, rain or shine. Far removed from those wet streets, Uber Technologies spent 2025 celebrating a financial victory. To understand this mass exodus of American gig workers, we have to look past the top-line corporate earnings and audit the driver's collapsing personal balance sheet against the platform's algorithmic design. This graphic is a cascading P&L, or profit and loss statement, which tracks a business's revenues against its costs. For a ride-hail driver in 2026, the math starts in a deep hole. The baseline fixed cost to own, maintain, and operate a new vehicle reaches $11,577 a year. Before a driver earns a single dollar of profit, they have to clear nearly $1,000 every month just to break even on the car itself. Then comes the daily liquidity drain. In early 2026, the national average for regular gasoline hit $3.71.08 per gallon. This price shock increased daily fill-up costs by 50%, forcing drivers who used to spend $30 a day at the pump to suddenly spend $45, severely reducing the actual cash they take home after a shift. Finally, localized commercial insurance markets began to fracture. In New York, the collapse of a major insurance provider forced state regulators to plan for 25% premium increases over a 3-year window, adding an average of $1,500 in new annual costs to a single driver's ledger. Uber attempted to address this with temporary fuel surcharges of 45 to 55 cents per trip. For the drivers absorbing thousands of dollars in compounding vehicle, fuel, and insurance inflation, those pennies are a mathematical rounding error. The gap between stagnant app payouts and exploding real-world operating expenses has grown too wide. Driving for a rideshare app has devolved from a viable livelihood into a high-risk cash flow loan, where workers trade the long-term equity of their vehicles for short-term liquidity. Uber did not magically become profitable overnight. The platform engineered its margins by heavily adjusting its take rate, the specific percentage of the fare the company keeps for itself. Over the last year, platform fees per trip increased by 33%. They paired this with a shift toward upfront pricing, a model that obscures the traditional per-mile and per-minute math in favor of a flat, algorithmically determined payout shown before the trip begins. This system drives down effective wages, forcing veterans who used to earn a living wage in 40 hours to drive 60 hours just to match their old paychecks. When local governments try to protect driver pay, the algorithm fights back. In New York City, Uber and Lyft began deploying lockouts, forcefully logging drivers off the app entirely during low-demand periods and leaving them stranded in remote boroughs. This lockout tactic exploits a specific regulatory loophole. The city mandates minimum pay based on a utilization rate, the percentage of time a driver actually has a passenger in tow. By locking out drivers who are waiting for rides, the companies artificially inflate their utilization rates, effectively erasing the empty time from the ledger to avoid paying drivers for their wait. The algorithm also serves as a ruthless HR department. Thousands of workers face sudden, automated account deactivations triggered by flawed telematic software systems that track a driver's speed, braking, and phone handling. A defensive driving maneuver to avoid a crash can be flagged as fraudulent behavior by the code, terminating a worker's livelihood instantly, without human review. Algorithmic management is not designed to optimize the driver's workplace experience. It exists to extract maximum margin for the corporate balance sheet, while meticulously isolating the human worker from standard wage and labor protections. The workers realizing this the fastest are often highly educated. Platform demographics show that 36.9% of all active Uber drivers hold college degrees. They can run the depreciation math, and they are actively planning their exit. They're leaving for the massive labor pool of the 2026 trade rebound. Fueled by the $1.2 trillion Infrastructure Investment and Jobs Act, the American economy has generated record demand for specialized physical labor and heavy equipment operators. The financial contrast is absolute. A full-time gig driver might net $25,000 to $35,000 a year after expenses. Meanwhile, high-tech trades offer immediate apprenticeships, leading to starting salaries where commercial electricians and elevator technicians routinely clear $85,000 to $99,000 annually. For an educated worker willing to hustle, the choice is clear. The gig economy has become a financial dead end, while licensed, union-protected trades offer a direct path to the middle class. Uber is completely unbothered by this mass exodus of human labor. Their long-term strategy does not rely on retaining drivers. It relies on transitioning the entire app from a rideshare service into a global marketplace for autonomous vehicles. The platform is already flooding with robotaxis. Uber has signed billion-dollar deals to deploy massive automated fleets from Uber-Rivian and Waymo directly onto their network. In San Francisco, the math is already visible on the streets. Autonomous units have captured 27% of the local ride-hailing market, and drivers report that the algorithm is actively prioritizing the most lucrative, high-frequency urban trips for the robots, leaving the low-margin, traffic-heavy scraps for the humans. This is a deliberate structural displacement, pointing toward a mature global autonomous market projected to hit a valuation of $41.75 trillion by 2034. The human gig worker was never intended to be a long-term partner. They were a venture capital subsidized bridge. For a decade, human drivers took the financial risk, mapped the physical roads, and built the digital demand layer, completely funding the arrival of their own robotic replacements.